Good afternoon, everyone. Myself, Sarun Adityan from Team GST. Today, in our final round of Blindspot, we'll be seeing about the three key flaws that we found in our ex company and what is the proposed solution that we have for these three flaws. So let's briefly understand what are these flaws that we found. Three of the most important flaws that we found. The first one being revenue inconsistency. This is the biggest and most important flaw that we found, which led to a lot of consequences again in the company and led to a lot of minor flaws that we found. The major cause of all that was the revenue inconsistency. The second most important flaw that we found was the discrepancy between net profit and EBIT. We'll also see about this later in our presentation. And the third and the last flaw that we found was the contradiction in cash flow. We'll also be seeing about this in our presentation. Now let's highlight mainly about the revenue inconsistency flaw that we found. The audit report records 5 million revenue in year 1 in the first quarter, while the financial sheet records in about 45 million. The ninefold discrepancy undermines every dependent metric growth, such as the growth rate, margin, the CAGR, and every other metric that we use to measure the business growth. That was severely hit because of this single issue. Oryx appears to have parallel reporting system, a narrative audit document and a spreadsheet-based financial model without reconciliation controls. So our solution to this problem that Oryx is facing is threefold. Let's see what are solutions. First, implement a single source of truth. An accounting-led ERP structured financial software where all revenue entries originate. And the second solution that we have is that we need to introduce a mandatory monthly revenue reconciliation protocol, matching our invoices, ledger entries, and bank inflows before publishing any financial figures. And the third and the most important suggestion that we are providing to the company is that appoint a dedicated financial controller or a CFO to review and certify all reported numbers. These solutions that we have provided is completely low cost, implementable within 60 days time frame, and it helps us in restoring the financial credibility that Oryx lost in the market. Now let's see about the second important flaw that we found in Oryx.
Good afternoon. I'm Shivansh. Now let's talk about the second flaw. The second critical issue is the instance where net profit exceeds EBIT, specifically in year 2, quarter 1. Under standard accounting structures, net profit can never exceed EBIT unless there is disclosed non-operating income. However, no such disclosure exists. This indicates either a calculation error, misclassification, or lack of structured income statement discipline. If left in unresolved, this flaw damages earning credibility and raises red flags during due diligence. The root cause here is weak financial modeling controls, like spreadsheet formula errors, combined with absence of independent reviews. Our solution focuses on structural correlation. First, standardize the income statement format permanently. Revenue minus COGS equals gross profit minus OPEX equals EBIT plus or minus other income minus tax equals net profit. Second, lock the financial model formulas to prevent manual overrides. Third, institute a quarterly independent financial review overlooked by a CFO or external advisor before numbers are published. These actions ensure earning transparency, eliminate structural miscalculation, and significantly improve investor confidence. Now let's look forward to the third flaw.
Good afternoon, everyone. I am Gena Bish, and we'll be talking about the third flaw today, which is your cash flow contradiction. So the audit report states that the flow turns consistently positive in year 3. However, the financial records show something else. It showed a negative $12 million cash flow in quarter 3 of year 3. Now, why is this contradiction dangerous? It is because this cash flow determines our survival, our runaway, and our scaling capacity. The root cause likely lies in the timing mismatches, incomplete working capital modeling, or failure to reconcile projected cash flows with the actual bank. So what is the correct strategy for this? First, it's to generate cash flow statements directly from the verified bank data and not projections. Second, it is to separate operating cash flow from working capital movements, particularly receivables and municipal payment delays. Third, it's to implement a 12-month rolling cash forecast, and which is updated monthly. Okay. The fourth is to establish a liquidity buffer policy, ensuring that at least 6 months of operational runway. These measures are highly feasible, require minimal infrastructure, and significantly reduce insolvency risk. So let us come to the final conclusion. In conclusion, the three priority flaws stems from financial control immaturity, not from business model failure. By implementing, first is your single reconcile reporting system. Second is your structured income statement discipline. And third is a robust cash flow governance. The honest transactions from early stage operational momentum to institution ready financial stability. The solution strengthen your sustainability, improve investor confidence, and enable a long term scalable growth. Thank you.